Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, May 7th, 2024. It's 10:45 a.m. Eastern Time, so we're a little over an hour into the trading day. Wanted to do an overview of the markets and then just touch on some of the recently highlighted trade ideas after that. But what we're going to do in the markets is just take a look at the sectors of the S&P 500. As I say, any index is simply a sum of its parts. When you're looking at the NASDAQ, it's more about the big tech stocks. Really, you can just look at the top 7 former Mag 7 stocks. In the S&P, you want to look at all 11 sectors. So we'll do that. So we're right where we were this morning, hair below. Got a post out to you right after the open because we opened up to hit that downtrend line. Again, that's a downtrend line off the highs. So this was a big support level that was taken and regained. So I shared my swing trading plan, and I also made clear an active trader. I wear both hats. Swing trades, made clear haven't been back and will not go back to a full short position until we go back under 433, unless if and when that happens. But as an active trader, I think there's easily a pullback trade to be made here, a little micro level right there. But I think we'll come back in a good chance, at least test 433, especially if we do get that rejection here. And then, as I said on there, there's two ways to do it. Again, you can wear multiple hats, the same hat. Maybe you're an active trader, maybe you're a swing trader, a trend trader, investor. But and I'm going to go over this video to show you why, what would support the case. But if we do get a reaction here, even with an active trade, which is, you take a full position, then just trail it down. If you've got if you start going down here, you can set your stops, keep them a little above entry, add entry for a break even, periodically ratchet them down. Remember, stops in anything you're trading, the tighter the stop, the better the chance you're going to get clipped out in just the back and forth noise, the zigs and zags, but you're also minimizing any givebacks and profits. So there's that kind of trade-off there. Volatility has abated somewhat recently, but it's still up there. I'm going to get to the VIX. Oh yeah, let me write that on my notepad here. I want to cover the VIX for you as well. So that's it. Let's not make too much of it. You can see there's a little minor resistance above it, and we've got at this point in time other things that say we probably turn down soon. The PPO it's not crossed yet, but it's poised to make a bearish crossover. That's a bearish crossover when the blue line crosses over the signal line there, and the MACD line. And so you look at the high level ones. This is a high level. I'm just going to circle where you got them, and then you can see what happened afterwards. So these are your high level bearish PPO crossovers, and they're good for at least short-term trades. I just circled them. You can see that. So that one turned out to give you that because we know the PPO remained down low below the zero line. So that was the last high-level bearish PPO crossover. And that was a short entry we had right after the Fed, day after the previous Fed meeting, not the last one. So there's, case to be made, again, for both an active trade and a swing trade, depending on your plan. And then, of course, if we go under 433. So now let's dig down a little deeper. So far, this is, healthy for a counter trend bounce. A lot of the equal weighteds, I checked yesterday. I didn't check again today, but we're about where we were. A lot of the equal weighteds retraced. They were at 50 or 61.8, typical fib retracements. QQQ itself's been a little higher, but again, it's the same story. It's the same narrative over and over. These Mag 7 stocks, check breadth indicators. I'm not going to do that in this video. I'll maybe do it soon. Percentage of stocks trading under their 50-day and 200-day moving averages still it's showing you that the market breadth is very poor. When you look at where the indexes are and the majority of stocks trading below those key moving averages. So again, it's just a handful doing the heavy lifting, and they've almost it's been about 3 or 4 that have been taking turns lately, with Apple lately kicking into gear. So we'll get to all these in a second there. So that's it. Take it, leave it, watch it, and again, if we take 433, I think I gave you some arrow breaks for potential targets today. All right, let's look at the sectors of the S&P 500, and then we'll move on here. So one of the reasons I wanted to do the video now, we're testing that downtrend line, which I believe is significant on QQQ. We can also add one here. You can see on XLK. Let me just add it. XLK is almost a mirror of QQQ because QQQ is mostly, it's over half tech stocks anyways. And so this one's going to mirror it. The big holdings in XLK are, I haven't updated it recently, but back then it was also the biggest sector in the S&P 500 as well, and it's mostly made up of Amazon, Apple, and Nvidia. I know these numbers have grown since 2022, and so it is also testing its downtrend line resistance, and it's also testing the bottom of its comparable level, and it's a hair above it. So like I said, today is either going to make or break the bearish case. I don't have any strong convictions. The price action has been strong recently since Apple reported. Animal spirits are strong. So again, in my opinion, not a good time to get aggressively short unless you're just going to keep stops relatively tight, taking a shot here at resistance. But what I want to see today, and again, I think today has a chance to make or break the whether the market's going to go to new highs or not. As I said before, I've been saying repeatedly, I think if it clearly takes out the downtrend line in QQQ, it's going to increase the odds significantly. And then with every tick higher, that we're going to go up and test and then ultimately punch through the previous highs. XLK, the tech sector, you can see is currently testing that comparable downtrend line, but it's a hair above the bottom of the range. I have this line, the yellow line really defines the bottom, and it's about 204.21. We're at 205.27, so that's 1 point on a 200-point index. So you're talking 0.5%. So we're there, and again, it's how we end the day. If we, this is what the candle looks like at the end of today, a big green candle up through there, or clearly above the 204-ish level, and the trend line, then that's nothing but bullish. And I would put an X there. Remember, we had a big check mark right here. That was the breakdown of the trading range on XLK. Went down. That was when we hit T2 on QQQ, providing an objective time to reverse, game of bounce. And so again, this looks almost identical to QQQ. I just want to show you this is a level. So if we close red today, then this is only going to be simply a breakdown and a back test of the trading range from below and a rejection off the trend line. If we close green, or more green, I should say, this one's almost flat now, then I just gave you my thoughts on that earlier. What would XLV, and remember, I take these collectively. This is why I take the time to go through the 11. We don't need to go through all 11 sectors. The big ones are all that really matters as far as weightings go. When you get down to the bottom, the weightings don't move the needle as much. So XLV, we had a beautiful, like so many things, a little topping pattern trading range there. XLV, healthcare sector, by the way, the second largest in the S&P 500, broke down, had 3 days of back testing, finally an impulsive rejection off the third failure to get back up into that level, and we're clearly below there. So this one clearly, to me, remains on a sell signal. I had multiple check marks, first with the trend line breakdowns, then the trading range breakdown, and we're still well below that. We're back testing the 50. So there's when this, if and when this takes back 144.55, then that starts to kind of negate those check marks. But so far, we're at XLK is right where it needs to be. We haven't erased the check mark yet, at least not on a closing basis. Intraday we have, but again, how we close, that was XLK, the tech sector, first one I went over. XLV, still, just looking this through a clear lens. This is just an uptrend. We had a consolidation, a breakdown, and so far nothing more than the first counter trend bounce following that initial leg down. Could certainly morph into more, and if it does, then that's just going to add more fuel and build the case that the S&P and the NASDAQ will want to make a new high. Until then, this one's not done that yet. XLF financials, the story of it, when I look at this, just a lot of whippiness, but I'm just going to, right now, here's what it is. We had the primary uptrend lines off the October 23 lows right there. I had that one in a BOD. BOD means benefit of the doubt. That was my primary in the benefit of the doubt. We also put in a bearish engulfing candle at the highs right there. So that's a trend reversal candlestick pattern. We had an initial leg down, which is certainly what that was. We had a counter trend bounce. We started going down again, but so far they truncated that move and we're back to that previous high. So this one is still below the bearish engulfing candle. It's still below the breakdown point, which is right here. But we're coming up, we're testing that previous high. If it goes much higher today, then what we have in the near term is the makings of a near-term uptrend in the financial sector. Right now, we don't have that yet. We haven't taken out that previous high. So, this is, again, a lot of technical evidence can either chip away further at the case for more downside and those deeper targets on QQQ. Or again, if we get rejected and we go down and we take out the previous lows, then that can help support add the case we're still going down to the 200 days. And this is what I'm talking about, whippiness. You had a nice clean downtrend line off the highs, right? And that was taken out recently. You also had a clean uptrend line there on the counter trend bounce. We broke it, but then it got truncated again with Apple earnings. So like I said, there's a lot of whipsaws lately. And I'm trying to just paint the bigger picture and show you the levels that will matter both in the near term to open up, either build the case that we're going to go to new highs or or strengthen the case that we're going to go have another leg down and hit the 200-day moving averages and those longer term targets I gave you on QQQ last couple of months. So this one right now, like I said, we're going to chalk it up to if it builds on these gains and closes above where we're at now, we're up 0.5%, then I'm going to give that a check mark for the bull case. So that's what I'm doing here, a little kind of like color by numbers or paint by numbers. This is kind of read the market by check marks. XLY, I know this is a busy looking chart, but the key yellow line I had here was this uptrend line right there, comes off that October low as well. So many things had that level. Breakdown, back test, rejection, initial leg down. That was also off a divergent high right there. And so that was a leg down, followed by a counter trend bounce so far, and still above the previous reaction highs. There's an uptrend line that needs to be taken out. But again, all I'm seeing lately is one whipsaw after another. You had a trend line here, breakout back test, so that's bullish. And so we're going to kind of give it, if it takes out this previous reaction high, that's going to give another check mark for the bull case. If it takes out this trend line here, pretty much, to give a high degree of confidence, we're going to go down and have another leg down and go to the 200-day moving averages in QQQ and a lot of those big stocks and hit those further deeper targets on QQQ. We're going to have to take out the recent lows. So we'll do it one level at a time. And like I said, the fact they took back 433 in itself increased the odds that we're going to go to the, continue on up. And if we, build on today's gains, as I showed you, being at resistance, and particularly in QQQ with that downtrend line, then that's going to, open the door for a move up. And it's not much. You're talking, to get to the new highs, it's only a couple percentage points in the Qs. Let's move on here. So XLI industrials, again, bigger picture, primary trend line there. We had a trading range right here. We had a breakdown, back test, rejection. After the breakdown, we had an initial leg down. We hit this 120.41 support, and then we hit it again. We kept hitting it. We had a little trading range here, and this one has now taken out that previous high, and it's currently back testing the trading range. So so the bottom line is, as I've gone through now 5 of the top sectors, none of them have made new highs. They're all, if you want to, it depends how you want to, microanalyze the trend, the current trend. I talk about near-term trends, bullish, bearish. Bottom line, this is the previous high. Until we take out those highs, anything can go. You can do this, and then you're going to say, one leg down, there was a reaction low, reaction high, which was lower than that one. So what I'm trying to say is the case is not erased. It starts to incrementally get diminished as you go up from where we're at today, and mainly on the indexes as well. But I'm just showing you each of these sectors. And remember here, the common theme, guys. Let me reiterate this. And if you haven't noticed, that we're still off the highs on all these sectors. They're off the highs, and so it's not a foregone conclusion the market's going to go to new highs right now. And I'm still very much open to a reversal, but it has to happen sooner, or I get less open to it. And I told you I'm not gonna bet it or add to any bets on it unless I see what I'm covering in this video. We need to get pretty much rejected about where we are right now, and or very soon on most of these sectors. Ideally, sometimes you get double tops and all this other stuff, but I'm not going to go in. There's a myriad of possibilities. I'm just talking probabilities. So there's XLC. XLC, again, like so many things, had those primary uptrend lines were taken out, impulsive selling, initial wave down, gappy little sucker, because this one is a chock full of alphabet and what is that in there? Meta and alphabet. And so Meta gap down, there was the effect of Meta, and then Alphabet went up. And so what I can tell you definitively, we're at this level, and this is a level I've had here for a long time. This line was created back in May 7th. Okay, maybe I just added this. Okay, sorry, I know these lines were here. Either way, I added that because that was support, and then you see the impulsive breakdown. And then you see a back test and a rejection there, and that's where we're at again. So again, this has now become a clear resistance level, and obviously net bullish if we can get above there, especially close solidly above it, and then bearish if you get rejected. Although you really still need to take out the recent lows. If we take out the recent lows now, it'll be that waterfall that down to the 200 days I think that I've been talking about. Is it odds or the risk for a sudden swoon up to break new highs there as well? Yeah, if we take out, and here's a downtrend line that's already been taken out. So we're starting to take out some of those downtrend lines off the highs, and some haven't been, some have been. XLP, this is the one, then this is consumer staples. So, in a growth environment, this is the one sector. Remember, I always talk about this. There's a couple sectors you don't want to see doing well now. One of them being energy, obviously, because that's the inflation trade, and that's the bane of the markets and Powell right now. Anything inflation, especially energy, the biggest component. And then consumer staples, like utilities, are defensive issue stocks. That's where institutions move money when they see the economy slowing, because growth stocks tend to suffer. And consumer staples are things you need: toilet paper, paper towels, and shaving cream, whatever, things that you have to buy, not things you want to buy. Discretionary, which we already covered. That's the sector that those are the things. This is discretionary, things you want, and then staples are things you need. Okay, and so that one is at a marginal new high, but still very much divergent high. It had negative divergence when it peaked back here and broke the trend line. And sometimes you go down. There's always going to be counter trend rallies along the way. So what you can see here is I've set another trend line there. And again, the fact that it's staples, I'm seeing institutional money moving into these staples. And again, that is indicative that the economy is rolling over. And I have pretty strong convictions we'll still see in hindsight, they'll declare 2024 was the beginning of a recession, but only that's the NBER does that well in advance. Well in hindsight of when a recession actually begins. But that's what institutions are doing, and so I just wanted to update that. And it does weight on the market. It does have a pretty good weighting to the indexes. And by the way, this, like many other sectors, is still well off its highs, its all-time highs. So really, we're just talking a move up there, and then big resistance here at 77.68 right there. XLE, like I said, the one sector you don't want to see doing well because this is the inflation trade. Got a little hot here recently with crude oil and everything, and I mentioned crude as being a short to hedge index shorts, and crude went down, so this is just going to follow crude, and that's where it's at now. But as I told you recently, crude's coming up to a really nice uptrend line support. We're still just a hair above it, but we're also at price support. So, and you can see this PPO as a trend indicator. When you're above it, the trend is bullish, and when you're below it, like here, the trend is bearish. And so you're coming and back testing that zero line from above. So I wouldn't be surprised to see another leg up in energy. Okay, the rest don't matter really. You can trade them, utilities, but it matters in the fact that, again, these are the defensive sectors, and these are what institutions seem to be moving into right now, just like treasuries. Treasuries are also defensive, and that'll bring me to the next one. We'll just do it since I mentioned it. TLT, gave you that as both a pure play trade idea right here off the lows, as well as a hedge, indirect hedge. Worked very well, worked well for me. I told you I removed that hedge the other day. I think it was right there. But still, told you yesterday I wouldn't short it because it still may come up to here. As long as treasuries are rallying, it means rates are falling. That's net bullish. But we're also at, that's why I wanted to do an update, we're at resistance. So, maybe we go to that trend line, maybe not. But we're at resistance, so probably get a pullback here. In fact, I'll have to look at, I don't want to get sidetracked too much. I just wanted to give you a brief update there. And I may throw out I'm going to look at ZB and ZN, the futures, and see if it's worth a quick pullback trade here. Because I suspect the market's going to pull back. So Treasury bonds will probably pull back too. And then, CNBC will come and cite the reason that the market's pulled back was an uptick in rates or some crazy BS like that. Like I said, they always try to retrofit a headline or a cause for every move in the market, up or down, whether it's the right one or not. All right, so there's Treasury bonds. So you're up to date on the sectors, individual stocks. If we do, I just want to mention again, throughout Intel recently, it's at long-term support. This is really the case here. If the market holds up and we go to new highs, remember right before this earnings season, and multiple times I listed the two most bullish looking stocks of the Mag 7 were Apple because of the positive divergence right there. Unlike the others that had negative divergence, Apple and Tesla. And so Apple from that divergent low rallied 13, almost 14%, and Tesla off that divergent low rallied 43%. And then that's the level when it was getting to that level. I said if you took it, it was mentioned as one of the best looking, those two in particular, then that's where you would want to most likely book profits at 198.16. And that's what we hit. So it's pulled back. And then the other ones, so Intel, again, if we're going up, one of the better looking ones, we don't have the divergence on the daily. Divergence isn't the be all end all. It's not a necessity to go long or short a stock. But this one is at long-term support right here. You had this trading range right there. And then we went long twice back here off that even deeper support. But extremely oversold. Not extremely, I'm sorry, just oversold on the weekly. But usually oversold will do the trick. When we get extreme oversold, we were in that bear market last year or a year before, and that's when we got down to that extreme oversold reading. But usually you can see I'm circling right there. Those were your buy points before on Intel. That one gave you that one gave you that, or however you wanted to trade it. And so we're still there, guys. I just want to mention it's about 31-ish support. And on the daily, you don't have the divergence, but you have the PPO and RSI turning up at high levels. Very low levels. And then the other one that looks like it, they reported today. So I threw out MKTX, and now earnings are out of the way. They beat. So that's one of my top picks for a long side trade right now. You've got let me add that there. Yeah, I can see a downtrend line off the highs right there. Oh yeah, there you go. All right, so if we can, that was the first target I gave you before, 211. We're there now. It was bought off 200, so you made not much. That's 6% or 5.5%, 200 to 211. But next pop, if we pop that, we're going to take out the trend line too, and then 228.50. That would be the next target there for MKTX. And remember, they are involved in bond market, bond trading. And treasuries have been going up, so their chart often meshes with interest in treasuries, and so that's another one. I don't want to do a deep dive in the grains. You guys know I'm bullish and long the grains, and we have them. But I do want to mention this: wheat forever and a day, even back here. I've been pointing out wheat with these divergences have been building. We've been buying it since back here. It's really one of the same trade because we never ever exceeded the marginal new low. I've kind of let it go before and then revisited it back here off this most recent divergent low. It's been a big basing pattern, but if you go back and reference all the notes, or you recall back here, we kept hitting T1 again, and back here I was saying, you're going to get the real buy signal. The big buy signal is going to come if and when this level is taken out. Now, keep in mind, this is the ETN. It does a good job. And I've said this before because I've heard criticism on the site from some of these agricultural ETNs or ETNs in general. I trade futures. If you don't, if you can't trade futures, so you don't have a futures account, you can't trade wheat. There's nothing else that directly invests in wheat that I know of, ETFs. So, and it does a good job. You're going to get a K1 at the end of the year, big deal. It's not the end of the world. But anyway, I just wanted to point out we're at that level, which is 607. We're at 608 right now. And so I maintain what I've been saying before. And what happens too is, even though I'll use ZW, and a lot of pros will, there's also quite a bit, and I've even seen over the years a lot of, even some big hedge funds do buy ETFs and ETNs. They'll buy GLD, QQQ instead of futures. So it's not all professionals always trading futures. And what I'm getting at, quite often it's the tail wagging the dog. That the ETNs can have enough buying or selling pressure that it influences, because they're then turning around and buying or selling the futures to track what they're tracking. And so a breakout on wheat could do the trick. Now, on the ETN wheat that I just showed you, these are the futures. This is a long-term chart, end-of-day chart. So it's through yesterday's, but that's that bullish falling wedge I highlighted before. Big divergent low. I mean, I just love these commodities. I love any long-term chart. This is a weekly chart, and we've been trading wheat for years. These divergent lows. That was a 380% rally off that one. This one was, 110% off this divergent low. Oh gosh, I don't even measure all the way up, but you can see it's pretty big. And this is the most, that was a previous divergent low, and you got that. And now this is our most recent divergent low. So that's continues to be a swing and a long-term position, both swing trade and long-term trade. And again, so watch this. When you pop this level, it's probably going to bring in some additional buyers to wheat. And of course, corn and soybeans will usually follow, because they're the big grains. The corn already hit T1. We're starting to get above it now. And that's still second target up here, about 2178 in the downtrend line. Then you guys know the targets. I've covered these quite a bit recently. Soybeans also punching through T1 after hitting it recently. And I'll just color that up green. It's out of the way. Those are your targets there. And let's see what else do I want to cover. Let's loop back to the markets as far as the VIX goes. Let's talk about the VIX, because beginning part of this video, I'm making the case that just because we've taken out 433 does it certainly not mean we're going to new highs. Again, I expect so far we've had a reaction here all day. If you've looked, I'll get back to it in a minute. QQQ hit that downtrend line I showed you right after the open. In NQ, and it stayed there. That's a reaction. I define a reaction as one of two things. When you're going up, a reaction is either you hit a resistance level and you bounce, pull back, reverse, or you stop there. Just like in downside, when a stock's falling, I use my tennis ball hacky sack analogy. You drop a hacky sack on a hard floor, it's going to just hit the ground and stick. You drop a tennis ball or golf ball, they're going to bounce. So that's a reaction to the downside. So far we've had a reaction here. And the VIX, remember, the VIX, we're still coming off a big divergent low. We had that divergent low there in that rally, and we're in an uptrend in the VIX. And we took out this uptrend line when I excluded the post FOMC whipsaw. But turn off all the lines. You're still in an uptrend. You're still making right now. The VIX is making these higher highs, higher lows. I'm sorry, and higher highs, right? So there's still the potential that we're going to get another thrust up and then go on to hit some of those bigger, targets. Again, the VIX pretty much hit that trend line there and pulled back there on the last move up. And likewise, if we pop the downtrend line in QQQ, which I'll get back to, I told you I would, we take it out with conviction. This is where we're at all day today. Here, let me be it better on the 60. You can see it here. There it is. So we're pretty much, you've got a little spike here, a little spike I didn't include. You can play around with this trend line. It's this to this, really. It depends if you want to capture that reaction high or come in on that one right there. I had it on these guys here, kind of splitting the difference between these points here. So far that's what we're doing. We're just kind of flat-ish on the Qs. We'll give it credit, it didn't reverse so far, but the day's not over. And let's just look 15-minute chart. You've got some nice divergence here and an uptrend line. I started to mark that one up yesterday. So there's if you're looking. Some folks like to short rallies into resistance. Others like to short breakdowns of support. So there's your uptrend line, comes off the recent lows and gives you this divergent high right here on the 15-minute chart. And if you're an active trader, you've got a little first stop's going to be about right here. I'm going back. What I see here, it was support there, reaction high, a gap right there. So 436.90. If we do break this trend line, that would be the first stop. Then 433.53, and then there'll be a couple more in here. But then this potential uptrend line right there, if we get a little bit deeper correction. Again, go up much more, you're going to have taken out this trend line, and it's probably going to bring in some more buyers and cause some more short covering. Okay, I just looped over. I told you guys I was gonna do it after I wrap the video up, but I want to share this with you. I think it's relevant. So I just looked at ZB. Remember TLT? I showed you. TLT was what I typically will trade, although I'll track the 10-year for the markets and everything else, and also for ZB. ZB being the 30-year Treasury bond futures. This is ZN, the 10-year Treasury bond futures. But look, we're at a nice downtrend line right now, so this supports the case. That although we haven't gotten it yet, we're going to have a reversal now in the markets and rates, because bonds, I think we'll see a pullback here. You get maybe a little minor trend line you want to go down. When you see something like this, if you want to see how clean it is, go down to like a 5 or 15-minute chart. But either way, this is a rally into although ZB and TLT has a little more upside to that downtrend line. ZN, the 10-year bond, which is the same as IEF, is right at that downtrend line, and no divergence. Remember, we're coming off a divergent low. That's why we were long and bullish. The bonds off there. We broke out. It was a beautiful little falling wedge. So it was a great either pure play or hedge trade. Rallied up. We pretty much met the measured target of the wedge, the widest part, and then some. If we pop it here, you can see I have a yellow line. It's very important. It was very important support. In my opinion, we broke it. Back tested, rejected. That would probably coincide with a test of that resistance on TLT, the downtrend line I told you is a potential target if you're swinging it up. That's on the here on the 60-minute chart. See, a little more upside would bring TLT to that trend line, although TLT, as I showed you earlier in the video, is at resistance now, price resistance, but the trend line is even bigger resistance. And then I'll wrap it up with IEF. I just want to confirm. So here's let's see if the trend line's the same. It's not. It's close. You can see the reactions aren't as clean as a ZN. And remember, ZN is the Treasury bond futures, and they trade around the clock, just like the stock future index futures. That's why I like to use those charts. You're going to see more reaction points that you don't see in IEF, because IEF is an ETF. You're only going to see 9:30 to 4 p.m. trades. And then that stops. That's the candles you're seeing here, while Treasury bonds continue to trade around the clock. So that's the best I could put it. It's I had to miss that reaction high a little bit and cut that one off. So maybe here, yeah, you can do that. Come to that high right there. You see, the thing about it is I like to have 3 distinct reactions to validate a trend line. We don't have a reaction yet here. We do on ZN, the futures I just showed you. So yeah, I think probably it's not a screaming short. You could take a shot at that. It'd be better to see both at resistance, the 10 and the 30-year, to be honest with you. So I just want to kind of give you that. If you do take a shot, just keep your stops relatively tight. I'm talking about a short pullback trade on Treasury bonds. Or if you do that, if Treasuries do pull back, that's going to be an uptick in yields in the stock market. Sometimes the stock market doesn't react to quite often when it's in rally mode, it doesn't react to the initial pullback until it starts to see a trend evolving. But there are times it can. And remember, let's not forget, and I'll wrap it up with this, we're still in my orange zone, guys. This was the whole premise. The reason I predicted that QQQ would break down from that trading range. The recent trading range, because the bonds were in this orange zone where the market would start to take note of it. We've had an abatement in yields, meaning bond prices have come up, yields have dropped a little, but we're still in my orange zone and getting up close to the top of it. And like I said, if the market's going to go to new highs, you're probably going to see Treasuries come on up back into the yellow or even green zone. All right, guys, that's it. I'm going to wrap it up here. Get the video out to you. Those are important levels to watch. Yeah, and if you have any other updates on any of the trade ideas that I've covered, any sector ETFs or anything like that, let me know. And I'll continue to hunt for some more trade ideas. And I will most certainly do an end-of-day wrap because, like I said, today is, I think we're at a pretty important technical juncture for the market. And so how we close today can be telling, to at least the next, what's the next 4 or 5% in the market, up or down. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.